With the S&P 500 finally seeing some buying for longer than a day, the question is, will these 2 straight 1% advances finally kickstart momentum and lead us to a year-end rally? We're going to dissect a number of charts for the index to come up with that answer. We'll also look at 2 other areas in the market. First, healthcare, of course. XLV and many of its stocks continue to advance and make new highs. And also GDX Gold Miners. As we know, precious metals have continued to come back, and GDX specifically looks ready to break out. So let's look at the S&P 500 first and talk about the patterns. Now, we've done many videos, and really the crux of our work, as everyone knows, is the patterns, right? Because when they start to work from a bullish perspective, it leads to uptrends. Now, we know that has been happening over and over again, really from that key low in April all the way through the beginning of October. Then things have changed. We had a number of big 1% moves come back into the picture, and that just leads to two-way volatility. And two-way volatility equals messy charts, meaning that bullish patterns start to fail. And that's what we saw. And so when bullish patterns start to fail, then we have to be on the lookout for sizable bearish formations to potentially present themselves. And this has been happening over the last few weeks. And let's look at the biggest one first. And this is pretty undeniable, right? Looking at all the action from the middle of September through the end of November, we're talking about, right, over 2 months worth of price action, which was just part of this big uptrend up to that point. And then when things started to unravel, this suddenly looks like a huge top. And it's not just the S&P 500. There's many other areas as well. And so as the case is, when the market moves up, you want to see a dip. When that dip finally comes, it sometimes looks pretty bad from a chart perspective, which this is as well. And so we had a downside break a few days ago. Didn't last that long. Of course, we had the big up move on Friday and again on Monday. And so far, this bearish pattern is put on hold. Now, I typically say negated, but because of how fierce, right, the back and forth movement has been both on the upside and downside, we're keeping it on our pattern grid for a little longer, just to make sure things continue to move in the direction where they have been, which has been higher over the last few days. If we suddenly see reversal, which of course is possible, then this could be in play once more too. Another one, not as big, but just as important, is one we saw from a few days before that, right? We had 2 bearish patterns triggered last week. This was the first one. This one is also on hold, and only yesterday, after the big comeback or the continuation on Monday, November 24th, was this one also put on hold. So same thing. If you come back down to this area near 66.40, this will be then ignited once more. So 2 bearish formations that were live together for about a day and a half currently are still out there, right? These are the things we have to keep in mind, again, if suddenly the tone changes once more, but we've seen a lot over the last few weeks. And so on the plus side, right, all of this can just be the beginning stages of a much bigger bullish formation. And we know the S&P was down about 6% from the peak to the most recent trough here. So as we'd imagine, this would be the biggest bullish formation to be formed from the spring lows if this were to play out like this. And as we know, patterns morph into different formations as they go along. But as we can tell, anything that looks somewhat like this, we're really just going to use this peak to trough as the height of the pattern. Measure move, what do? Take the height of the pattern, tack it on to the breakout zone, and that gives us a substantially higher price target, which if that were to occur, it would be way into the 7,000s at that point and probably extend in terms of getting there, maybe in January or something, right? We don't know yet. These are the point. We're laying these out as a potential scenario, as at least a blueprint to follow. Now, if this obviously doesn't play out, it would tell us, well, it's not ready once more, and this may take more time to play out. And so a different view we're going to show in a second is, when these topping patterns have formed, a lot of people just have a bias one way or the other. And we've talked about this in the past. Your stance on the market basically dictates what you see, right? And so when you have a bullish stance, typically, it's hard to see topping patterns play out. And one way to give us a better understanding of what could happen, you just flip the chart upside down here, right? And this is, again, S&P 500 inverted. So this was the big topping formation we just talked about, right? The biggest one there, which just got to break down from 2 days ago, this is what it looks like if this were a bottom formation. Again, S&P 500 turned upside down, meaning that this would be a big bullish breakout. And I don't know about you, but I look for bullish patterns like this after a big downturn, right? This is the type of thing that we saw if this was a regular chart near the April lows. And as we know, bullish patterns that work out create the foundations for bigger ones. And that could be something to look for on the downside. The difference, of course, when you have bullish or bearish breakdowns, they happen much more quickly, right? And so this, if it were to occur and we have a reversal once more, S&P would break down, and this inverse S&P 500 would break out pretty consistently. And so one of the things, of course, that has changed just over the last few days is that Friday, November 21st to Monday, November 24th had 2 straight 1% gains. That hasn't happened too often. In fact, looking back just at the action from the April low here, it's only happened 3 other times, right? Most recently, on June 23rd and 24th here. And this doesn't look like much, but this was 3 or 4 days down in a row coming after Fed meeting back then. Of course, every Fed meeting is the most important one. Simply getting through that one in June with little damage and limited rhetoric was enough to create another buying opportunity for traders, which of course they gobbled up and off we went, and this uptrend continued. And before that, of course, it happened right 3 days after the low right here. And then more importantly, we always talk about this April 21st low because the market was down nearly 3% that day. Forget that because it seems like so long ago, but it was only 2 weeks removed from the low. And of course, the tariff rhetoric was with us in full swing. So there wasn't really a huge amount of relief knowing that things were still tentative at the time. So when that happened, right, and recently pulled back to within 50% retracement of this big move, there was a lot of people thinking that we're just going to revisit the lows once more. When that didn't happen, of course, what would you have instead? 3 straight 1% gains, which was part of a 9-day winning streak, which took us to May. And as we can tell by the rate of change chart here below, that's when things really changed, right? The character of the market just went from excessive volatility to non-existent volatility, whether we want to talk about that in terms of the VIX or the 1% moves that we track. And so the point being is what's happening again now, right? After a pullback of, let's say, 6%, with the market still relatively in this uptrend, will this be what the market needs now to then take it to the next level, break out from some smaller patterns, get to new highs and break out from that bigger pattern. And then, of course, that could lead to a strong December and, more importantly, getting back to those characteristics that are more consistent with uptrending price action. And so over the short term, we get clues from this as well. And one of the clues that we're talking about on the way down was that these intermittent rallies all failed to produce an oversold reading on a 2-hour chart, right? And so very simple, but very important because, that hasn't, when we saw that last, right, the market did very well, got to overbought and obviously made new all-time high and then extended higher from that point. But the ensuing attempts did not do so. And so obviously this last one, right, with the 1% advances in it, and so far another good day here on Tuesday, that this eventually could get back to overbought territory, which tells us, again, momentum is shifting or has shifted back to the positive. Another very important part was near the lows on Friday, this past just a few days ago, we didn't see an oversold reading. And you go back to all the pullbacks along the way, at least since August, each one of them either undercut that oversold zone near 30 or came very close to doing so. This time it didn't. So there was a slight positive divergence in momentum at that point, which of course then has led to a few good days for the market. So again, this will get back to normal, quote unquote, if the S&P again makes it back to new highs, and we've seen an overbought condition triggered as well. And so a few things did change underneath the surface. And we're talking about a trend under pressure. We're referring to the GoNoGo Trend indicator. And so all along the way, and we know this goes all the way back to the middle of May, we've been in a consistent uptrend, and this has been identified by the market being in go mode, right? Go mode meaning that the underlying factors of momentum and a lot of other things have led to these bars being blue and green. That just means it's in a bullish trend here. And so that changed, right? When the market was falling apart more so over the last 2 weeks, it was doing enough damage to shift this initially from bullish to neutral, and then whipsaw a little bit here to no go, right? And so that's important to realize just because we've been in this very consistent uptrend up to this point. We know, again, the character changes from time to time, but sometimes this is momentum can really flip to the downside. So, with bearish patterns starting to pop up, with bullish patterns failing, and now momentum from this perspective having rolled over, it makes you realize that we're in an important spot here, right? Inflection point where the buyers really need to step in and prevent this waterfall decline from happening, or else that could eventually take place. And one of the key areas we've been talking about recently, or at times, was 2018, right? One of the reasons was because back then the S&P was coming out of 3 straight months with no 1% moves from July, August, and September. And then the bottom fell out, right? Because October, November, and December were completely different. And that's when volume came back, volatility came roaring back, and of course, the 1% moves were extravagant as well. And so if you go back to that point, right, this is that time frame, right? July, August, September, very consistent rally to new highs. Probably forget how that happened back there this time, but very similar to what this looks like, right? Little by little making new highs. Until things change again, right in the beginning stages of October. And when that went to no-go, basically stayed like that all the way until the lows, right? A little bit of a head fake here at the beginning of December. So this is worst case scenario, is that the good vibes that we've seen over the last few days just get completely faded for whatever reason. And then downside momentum comes back with reckless abandon like that and creates a scenario like this into December. Not prediction, but just something to keep in mind. Now, the other part is that S&P had just pulled back about 6%. And there was another time in more recent history when the market was in an uptrend, pulled back 6%, and then turned higher. And that was right here in 2024. Remember, this was a key low here at the end of October 2023, which gave way to a very consistent uptrend, just like we've had before. This is where we're comparing this comeback effort to this particular time as the market continued to move higher in a very consistent way early in this comeback. And so we're looking at the time when we had very little pullback from a high here until about 5 months later at the end of March to April. That produced back here in 2024 a flip of the GoNoGo indicator as well. And that stayed even after the market turned, because that sometimes it's a lagging indicator in that sense. It then led to another few more months of great price action until the pullback in July and August came. And so this could be the same type of thing now. Going back to this chart, we know it started back here. The first pullback 6%, it's not going to be perfect like that, but that's how it could play out to the upside. So 2 specific and very different scenarios from a go-no-go perspective, but we have to consider all of them as we go forward, of course, through Thanksgiving. Okay, so we're going to turn to healthcare now, but before that, if you like this kind of content, check out our free Substack newsletter, Cap Notes, where of course you'll find a lot more premium content, trade ideas, and access to select premium content. And if you sign up today, you'll receive our 6-step trading process that powers winning chart trades and limits losses. This is a simple, proven framework for spotting high probability setups. Again, it's capnotes.substack.com. Look forward to seeing you there. Okay, needless to say, healthcare has been on a tear. So there's a number of charts here that show this. Let's get through these. Number one, this is a classic basing pattern that, again, had some volatility like everything did through the early months, and then also as we got through summer as well. And we were talking about a chart back here showing that in May that it had the worst relative performance versus the S&P 500 in its history. So at the very least, the thought was that probably couldn't continue or shouldn't continue. We never know when things are going to turn, but that set the stage for then, again, more back and forth movement, but eventually, holding this low and then forming an inverse bullish formation, as we can see here. So we got the initial huge move through that zone here and then just produce a lot of back and forth movement. Again, people weren't really convinced just yet because of how many times we've seen it fail before that. And again, getting back to areas where there was some congestion before as well. But as things turned out, of course, it's just been as good as you could have expected at this point. Forming these bullish continuation patterns, you can call them trading boxes, each one of them, of course, broken out to the upside with this last push higher, potentially forming the next trading box as well. That, of course, we're looking to see if that can be levers to the upside too. Now, the other thing is that as this has developed, right, there's been some strong bursts along the way to the point where this 8-day rate of change shows 3 different times since August that the 8-day percentage move was at least 6%, which is really high, as you can tell. Going back to 2024, this didn't happen at all. Now, surprisingly, that was when the market was having some trouble, of course. And so you go to these points, and first time we pointed it out was that it did pause, pull back a little bit in September, but then regained its mojo. Same type of thing. Another huge move, another 8-day rate of change of at least 6, almost 7%. What did it do? Sideways, consolidated just a bit, and now for the third time did it again. So again, we can group all of these in trading boxes, call them bullish flags, patterns, or pennants, whatever have you. But seeing strong moves like that, just digested and nothing else, just shows you just how eager buyers have been to step in, even at higher prices. And that really hasn't happened in other areas in recent weeks, but it has in healthcare. And so now looking at this from a weekly perspective, needless to say, all of this has finally produced an overbought reading. And it took a while, right? And don't forget, it hasn't really been oversold though. Get very close. It's actually amazing to think that this weekly RSI didn't get oversold, considering all of the weakness that preceded it, which makes you realize how strong the ensuing bounce must have been to actually create an overbought reading, right? So the first time this has occurred since late 2024. So needless to say, this is a condition, not really a signal at this point, but let's just look at this action going all the way back to 2017. And again, when we talk about the last time something happened, especially from an indicator perspective, we're looking at a time when that first occurred in the past, right? Meaning that at times it can persist for a little bit, but what happened after it first got overbought from a weekly perspective? And as you can tell here, a lot of the times it happened in an uptrend. So no big deal there, continuing to buy. But if you look closely enough, we can tell that each one of these periods eventually saw a pullback that undercut the zone that which produced an overbought reading, right? Here, undercut again, of course, COVID, 2021, every single time. So that tells us to what? If we want to buy now, of course you can, but the odds are that we're going to see lower prices from here at some point. It may happen in the next few days, may happen in the next few months, weeks, what have you. But again, this shows that this has happened every single time. So meaning that we may get this overbought reading to finish the month or to finish the week, and then at some point have some consolidation that will give us a better entry point going forward. So I think that's the most important thing to take away from this chart. And so again, looking at this from a weekly perspective, you just see how substantial the breakouts were, right? And again, every time we see something like this, we feel like it's never happened before, but even the longer term chart shows that patterns tend to repeat. And this has been repeated by showing that this is a double bottom from this perspective, just like we saw from 2023. And just like we saw then, those targets were initially achieved. Market continued higher, or the XLV continued higher after that, right until the fourth quarter of last year. So we'll see how high this one gets with the XLV again, getting very close to making new all-time highs. And so looking at the monthly chart now, going back to all the way to 2009, we know that it continues to be in an uptrend. And this is one of the key areas that we highlighted again back in late spring, early summer, showing that It was extremely oversold, both on a daily basis, absolute, and also versus the S&P 500 right back then. Remember that it had that worst monthly performance versus the S&P at the end of May. If that happened right as XLV was testing this uptrend line and getting very close to key support from 120. So you had a confluence of very long-term support and oversold both on absolute and relative basis. It just worked out to show us that the risk reward was in our favor finally. It took a lot of pulling back to do so and a lot of false starts along the way. But when you have the short term and longer term lining up like that, it gives us a better sense that things could reverse. And so with XLV, so extended at this point on a short term basis, the question is, what can we expect going forward? And so one interesting comparison is to look at what GDX did. And if you could put both of these together, obviously XLV was moving sideways for longer than GDX, but GDX, as we know, in gold and silver and everything related to it, on a huge run from August all the way until October. So really strong run for a few months and finally pulling back. And look what XLV has done since that point. Again, we can take any starting point that we want here, but really things took off, right, starting in late September here and then continued to rally to a point where it looks really similar to GDX at this point. And so, as we recall, as we know now, GDX pulled back and now it's been trying to rally. But I think we should look at this more closely to see what it has been doing over the last few weeks. And so, looking at GDX Gold Miners directly, we can see now that it's very close to completing what looks like a bullish cup and handle pattern, right? And if it were to do so through this 80 zone, it would produce an upside target of 102. So that's great to know now. But again, as things were falling apart here, it didn't look as likely for that to occur, at least not right away. And so what that was happening at that time, when the market pulls back like this, it was really in a free-for-all. And so as we know, that's more a kind of support discovery. There really wasn't that much to key off on considering how strong that rally was. So we always say this takes some steps, right? Number one, you need to see support either held at or established. And that looked like, again, it was maybe around this point here. We could put the Fibonacci retracement on there, is around 50, and also the 50-day moving average is right there as well. So all that together seemed to at least stop the bleeding just a bit. So the market did find some support there, right? But because the rally initially wasn't that good, it formed what? A bearish formation, right? Occurring right here. And again, with even lighter support underneath that zone, it was extremely important to see that hold and not break down, which of course it did. And then as we just talked about before with the S&P 500, when you see failed bearish patterns, it gives way to what? Bullish formations. And at that point, then we saw the higher low, and now we're getting ready to see a potential breakout of that. And again, from a long-term perspective, we knew that it got really extended, right? Really overbought from this angle with a weekly RSI at 80. We knew that couldn't hold. And honestly, we thought that this would pull back more from a weekly RSI point of view, got down to the 60s and now hovering around 70 once more. The most important thing from this is that, we'll see if this bullish pattern works out or not. But on a long-term basis, continuing to see this weekly RSI just kind of hover near overbought in between the 50 zone. Again, we talk about all the time, but this is just something that confirms the uptrend. Seeing momentum stay in a bullish phase, again, between 50 and 70 will maintain this uptrend and again, allow it to consolidate along the way, form more bullish patterns and break out. So we wanted to show all this for the GDX for a few reasons. Number one, to show how it has played out and that in an uptrending market like this, just because you have a substantial pullback after a parabolic move doesn't mean the end is always near. The best case scenario was to do exactly what GDX did, was to eventually see some support and then have that develop into a bullish pattern. So if we're talking about the XLV potentially doing the same thing, or SMH, semiconductor ETF, or anything else that is extended, that is how these uptrends can persist. And if you look back in history, the same type of thing occurred in 2020, 2021. Sometimes we forget how that played out on a day-to-day basis. We just see the uptrend. So for this uptrend to continue, we need to see the same kind of scenario play out now. Thanks very much and have a very happy Thanksgiving. But before you go, don't forget to check out these other videos here.